Even as its chief executive Sam Bankman-Fried resigned, embattled cryptocurrency exchange FTX is set to initiate bankruptcy proceedings in the United States. The announcement has triggered what many experts have said could be one of the biggest meltdowns in the industry. With FTX's dramatic collapse and the crypto markets facing strong global headwinds over financial year 22 and 23, do we hear a death knell for cryptocurrencies? The collapse of FTX, considered by many as a white knight of the crypto market, marks a stunning reversal of fortune for the company and its founder Sam Bankman-Fried. It also raises questions about the future of smaller firms like BlockFi and Voyager Digital, which had signed rescue packages with FTX earlier this year. But why is cryptocurrency market facing stumbling blocks? Business Standard's Devanshu Datta explains.
Cryptos as an asset class started collapsing about 6 to 10 months ago. The combination of high inflation, strong dollar, Ukraine war, etc., all generally spooked investors. And since essentially your valuation of something like crypto is entirely driven by perception, since it's not anchored to any fundamental asset as such.
FTX's collapse has dealt a fresh blow to the cryptocurrency industry, which has seen severe volatility and bankruptcies of other high-profile firms, including Celsius Network Limited. This has caused the White House, which said it was closely monitoring the collapse of digital asset empire, to call for stringent regulation of the cryptocurrency industry. A proof of reserves has emerged as a popular option for regulatory tools. Can proof of reserves prevent future crypto exchange collapses?
We would really have to wait and see what's the real implications, because what exactly a proof of reserve does, it gives a third-party audit to actually audit the systems of the crypto exchanges. So a third party is primarily doing an audit to find things are in place, things are transparent and efficient, primarily to gain the confidence of the investors. So such kind of a concept would actually bring the confidence of the investors.
Datta agrees that the utility of proof of reserves will be subject to other factors.
So of course, proof of reserves could make a difference, but it could only make a difference to a certain extent. If the transaction volume is higher, transaction and default volume is higher than your reserves, then the exchange will default anyway.
Saha also argues that central bank digital currencies or CBDCs are not a viable alternative.
CBDCs can be an alternative to crypto exchanges. I would really say it might not be, because cryptocurrencies are digital assets, and CBDCs are essentially, a digital fiat currency, right? Primarily owned by the central banks. Of course, the confidence level and the reliability is more because it's being owned and functions and operated by a central bank authority. But it's certainly not an alternative to a cryptocurrency, because these are not digital assets.
Datta even highlights that CBDCs are ideologically opposed to the idea of cryptocurrencies.
First things first, cryptocurrencies were thought up specifically because the first lot of people, Satoshi Nakamoto, whoever he or she was, and the pioneers who came after that, actually wanted to avoid getting controlled, as they thought, by fiat currencies. So there's a clash of ideology.
Regulation seems to be a practical way forward in stabilizing the crypto market. However, implementing regulatory tools like proof of reserves can be challenging. It needs to be introduced considering several other factors ruling the crypto market. With a looming fear of global recession, if a well-strategized solution is not adopted soon, this might well be the beginning of the end for cryptocurrencies.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.